Hi, welcome to my channel. My name is Gil Rossi, investor and funds manager. Today I want to discuss a real example with real numbers from something that happened to me 2 weeks ago, roughly. And it's related to investment risks, something that we discussed in the previous video. So I received an email from a friend who lives in Spain, and he has a banker who was offering him some advice on investing his funds in that bank. And this is the email. It's an email that he received from his banker, and the banker was offering him options. He said, the officer said, if you have in mind low volatility here, and very low commission, this is the fund that I am offering you, Santander Asset Low Volatility. Of course, the officer works in Santander and is offering a fund that is managed by Santander. So you can see there the conflict of interest. If this officer offering the best suited fund for my friend, the client, or is he offering the best suited for himself and his bank? Who knows? But I think that you have an idea of what is he thinking in terms of motivations. So I went and checked what the brochure or the prospectus of this fund, and it says that it has a management fee of 0.35%, which doesn't look bad, really. Moderate allocation, so it's sort of like a conservative fund. It shows, they say that it has an attractive level of return. It invests in fixed income instruments and equities, not more than 15% in equities, and follows a systematic investment model with a risk control mechanism that allocates its assets between two baskets, defensive and risky. So it looks really, really nice. No? If you don't know much about finance, it looks awesome, really. Then you have here the annual volatility, quite low, and the performance. They show the performance from April 2000 since the new investment policy. But if you see here, I went and see longer time performance, 5 years, and you see that they were showing only this little bit here, but this is how it's done in the past. So it can have big swings, it's not that it doesn't move. But if you see on the longer term, you get a flat return in essence. The returns that you receive when you invest in bonds are interests. That's all, mainly. You are not thinking about capital appreciation, because capital appreciation when you invest in bonds depends on interest rates moving down. So the only way that you can get capital appreciation when you invest in bonds is if you are lucky enough to have a period in which interest rates go down when you're investing. Because when interest rates go down, your bonds become more valuable, because your bonds in essence pay a higher interest rate. But in the current environment, it's with the interest rates close to zero, there's no way to go down further than zero. Even some governments are offering negative interests, but of course that cannot become too popular, because investors will prefer to have cash instead of paying someone that they are lending someone money and they are paying someone money on top. That doesn't make sense. If you see here, the 5-year return in capital appreciation of this fund has been 0.43, so the full 5 years. So if you put $100, you end up 5 years later with $100.43, nothing. But you have to focus in interests mainly when you invest in bonds. So if you're investing in a fund like this, which invests in fixed income, you don't want, you're not expecting to make too much of a capital appreciation. But here it's an interesting thing. I went to check the income statement of this fund, the Santander Multi-Asset Volatility. And if you see income, which is what you expect to receive when you invest in bonds, as I said, is $33,000 on this euros on this half year, since January to June 2020. On 11 million invested, they get 33,000. But here is what's interesting. The expenses of the fund in between management fee, which they showed it was 0.33, which 35, which looks nice. If you go here and you see 0.35% management fee doesn't look that bad. But they are not telling you that not only you have to pay management fees, you have to pay depository fees, bank interest, annual tax, audit fees, administration fees, other expenses. Who knows what that is? All in all, 99,000. So 3 times what you receive in interests. So probably this is a bad year. Probably this is a bad half year to compare. I don't know. But what I know is that for most probably whatever I receive in income in this fund is going to go to be wiped out at least 100% or probably 3 times it in this case by expenses. So if I've been offered to invest in this fund, the proposition that I'm getting is low volatility, yes, and that seems to be like showing that low risk from the perspective of the banker. The banker telling the customer, I am offering this because it's a low volatility thing for you, and I think because you are a very conservative investor, I think this is what you deserve. This is what I recommend to you. But in essence, what he's recommending, the banker to my friend, is I'm telling you to invest here, and this is a proposition that you're going to lose money for sure. I don't know how much, but you're going to lose because it depends on the expenses, whether they are 3 times as big as the interests or probably 1 time as big. Doesn't matter. The proposition is that you are going to give me money. I'm going to make lots of money, and you're going to make nothing or lose money. And if we see it in terms of real interest rate in inflation terms, the person that invested 5 years ago here received nothing in interest because everything was wiped out by expenses, and received nothing in capital appreciation. So in essence, that person, if inflation has been, let's say, 1 or 2% per year in the last 5 years, let's assume 2%. So this is 10%, let's say, in 5 years. So now he has the same amount of money, but he only can buy 90% of what he used to buy. So he's losing 10% in essence. He's not losing 0. He's losing 10%. So this is really an ugly proposition, I would say. This is what I told my friend. But I think this is a very good example to show how volatility and risk are not necessarily connected. Let me show you here another of the alternatives that my friend got from his banker, the Santander Horizonte 2027. This is a fund that you can see here has a concrete objective of profitability. And it says here, this fund is not suitable for investors that are planning to withdraw the funds in less than 6 years' time, before January 2027. So one thing I wanted to show here, the officer knew already that my friend had 6 years of investment horizon at the minimum. So because he was offering something that has to lock the investment for 6 years. So he already knew that, as you saw in the previous video, if you have 6 years of investment horizon, then you shouldn't care about variability that much, because as you saw, even if you invest in the stock market, the variability is going to be small if you have six years that you're not touching the money. So the investment that he was offering was going to give an annual return of 0.23% per annum, not guaranteed. And that was coming from getting an objective of profitability to recover 100% of the investment plus 5 annual payments of 0.27% of the capital invested. So you can see here, it's offering 6 years to my friend to lock his funds for a 0.27% per annum of return. Not even will cover inflation. And this is only if they can recover 100% of the investment, which probably it's going to be the case. But this is a preposterous, really, if the word is fine, preposterous investment offer, really. Just wanted to show you this because the low volatility one that we saw before was not a good one, but probably it was suitable for someone with a 1 year time horizon. So probably the officer thought that my friend had only a very short time to invest. But you can see here that he very well knew that he had a 6 years of horizon, investment horizon. So how can you offer this? I mean, this is really shouldn't be allowed, I think. And why is that? Why is volatility always been so important for bankers? Because bankers know this. They know about finance. They know that volatility is not risk. But to them, it's very good to have conservative investors that are willing to invest in things like this, which don't make much sense. But if you see it from the perspective of the banker, let me show you the size of the debt market. The debt market is $277 trillion. It's 3 times as big, 3 times the size of the equity market, which is $70 trillion. Also at the end of December 2019. So when a government or a corporation issues a bond or debt, they need a bank, and that bank will charge a fee for doing that. And normally the fee is anywhere between 1% and 3%. It's quite a big amount. Imagine if you're the government of the US issuing $1 trillion and even if you get 0.1%, whatever, because of course the US government will pay less than that, than 1%, but they will get a very, very large fee. So the banker is motivated to issue debt because they get a large fee, as I said. And the service that the banker offers is that they can place that debt into the market. And the market is my friend, the Spanish friend, the investor, who is there sitting and waiting for the banker to send the email with the best investment that he thinks is most suitable for him. But in essence, there's another conflict of interest there. Not only the conflict of interest that I mentioned at the beginning, which is offering the fund that his own bank is managing, but also now is being an intermediary between the issuer of the bond and the buyer of the bond, and being the issuer of the bond, governments and big corporations paying much more than my friend. Of course, they are going to try to make this person happier. And so what that means is that they will negotiate terms, and then they will try to place that paper to someone. So it makes sense that they have lots of people like my friend, very conservative and very risk averse, because they are willing to invest in bonds and not in that thing which is called equity, which is gambling. No. They invest in bonds. They are persons that with aplomb. And of course, it makes sense because it's easier to sell these bonds, which is the biggest market, the biggest income source, let's say, that investment bankers have. So this is a little bit of a way that I think a real example can can be illustrative of what risk and reward, how you should approach that, and how you should approach volatility and risk of permanent loss. So I think that it's okay to try not to get into too volatile investments, but don't be. I mean, think about all the implications. If you're going to enter into a proposition like the one that my friend has been offered, which is a proposition to lose money, well, that's a high risk proposition from my perspective, because as I said in the last video, the risk is the risk of permanent loss. And if you're entering into a proposition which you have 100 or 99.9% probability of losing money, then that's a very high risk proposition, even though the volatility could be zero. I don't care really. Okay, so I hope that you like this video. If you like it, please give it a like and subscribe, so you can have alerts for the coming videos that I'm planning to upload. And thanks very much for watching, and see you next time. Bye bye.